Hello guys, hope you are doing well. Welcome back to my channel. I am CA Chetan Kansara and I have been teaching the subject of finance for more than 25 years. Currently I am teaching students of CA, CFA, ACCA and CS. Today I am presenting a video on systematic and unsystematic risk. Let's discuss what do you mean by these risks. As a shareholder, when you buy a share of any company, you are going to face two types of risk. One is systematic risk, that is the risk of the system, risk of the market, entire market. Risk due to general factors, risk which is going to affect all types of shares, all types of companies, the risk which is going to affect the entire market. And the another risk is unsystematic risk. Unsystematic risk is company specific risk, risk due to some specific factors of that particular company. Let us elaborate this. Now, systematic risk. As I said, systematic risk is the risk of the system, risk of the market. It is due to general factors like, for example, interest rate risk. Interest rate risk. Now, when there is a change in interest rates, each and every company is going to be affected. When there is a change in interest rates, all companies which have borrowed is going to be affected. Each and every company's cost of capital will be affected. Say for example, inflation, it will affect all the companies. Okay, for example, political instability, recession. Some examples. Global crisis of 2008, everyone knows this. Entire market was down. All IT companies, all cement companies, all pharma companies, all FMCG, each and every stock was affected. Okay, so entire economy was affected due to recession. Okay, war impact, for example, central bank policy, all these factors, they affect the market as a whole. So if you have bought a share of say Google, you have bought share of say Amazon, then all companies is going to affect it, not only your company. If you have bought a shares of Google company and the market is down, so Google ka shares will also come down. It's not that your company will be coming down and all other companies are share price are intact. No, each and every company share is going to come down. But if the market is up, entire market is up, your share will also go up. So these are the factors which will affect the overall market. I repeat, the overall market. This is called systematic risk. Systematic risk, when the market goes down, remember, market will compensate you. When market is going to go up, your entire portfolio will be up. This is called systematic risk. Now when I say unsystematic risk, it is a specific risk related to that particular factor. Okay, say for example, in India you have bought a shares of say Yes Bank. Now recently there was a, not recently, few years back, there was a fraud in the company Yes Bank. So the shares of Yes Bank had come down. Why? Because of the fraud in the management. Now if the shares of Yes Bank have come down, then shares of State Bank of India, ICICI Bank, HDFC Bank will not be affected. Why it should be affected? It is only the fraud in Yes Bank which has affected the share price of Yes Bank. So when I say unsystematic risk, it is related to that particular company, specific company. Some examples. Management, wrong management decision. If a particular company has taken a wrong decision, then only that company share price will be affected, not all. Correct? Say for example, labor strike. If you have a strike of laborers in your factory, production will be affected. So only that company's production will be affected, not all other companies. So that company's share price will be affected. Right? Product failure, competition, all these are factors which will affect only that company. And what are systematic risks? Where entire market is affected. So if you have bought a share of any company and if there is a market risk, you are going to face it. And if there is a specific risk of that company whose shares you have bought, it will be affected. Okay, so company fraud, poor earning result, industry slow down, only that particular industry, that particular company will be affected. So these are called specific risk and these are market risk. Now, as an investor, which type of risk you can avoid or you can diversify? Which risk you can control? You can control specific risk. You can control unsystematic risk. Say for example, you bought a share of Yes Bank. Okay, now there was a fraud. Immediately you take an exit. You have to take a call and take an exit. But if suppose there is a war impact and the entire market is down, entire market has come down, then however smart you are, you have to bear that loss. Why? Because the entire market is down, everyone's portfolio is affected. So you cannot avoid systematic risk due to diversification, but you can smartly avoid unsystematic risk by diversification. Okay, now let us proceed further. See, these are the basic differences. Okay, now systematic risk, unsystematic risk. Systematic risk are market wide, every company affected, as I said, and this is company specific. Systematic risk uncontrollable because entire market is down, you cannot do anything. You bought shares of TCS, you bought shares of Reliance, you bought shares of Sun Pharma. Each and every industry is affected because of recession, because of war, because of some general factors. But unsystematic risk is controllable if you diversify. What is diversification? Suppose you are investing $100 and you are investing $10 in 10 companies. This is diversification. There's a very good example in your Kaplan book. Say for example, you are buying shares of a company manufacturing, say, raincoats, and you're buying a share of a company manufacturing sunglasses. This is diversification because both are opposite. If there is a sunshine, what will happen? Sunglasses company is going to prosper. Sunglasses company is going to have a good sale. But rainfall company, the raincoat company, that won't be making profit. But suppose if there is a heavy rain, then raincoat company is going to sell the goods and share price will go up, but sunglasses won't be sold. So you have done diversification. If there is a profit in one company, there will be loss in another company. So planning your investment in this manner is called diversification. Then systematic risk, non-diversifiable, as we discussed, diversifiable. Systematic risk can be measured by beta. Okay, and this is measured by variance, standard deviation. Standard deviation. Standard deviation, this will be the total risk basically. Variance will be the measure of total risk. From that you are going to deduct the systematic risk to get the unsystematic risk. Okay, so these are some examples of systematic and unsystematic risk. Fine. Now, what is the conclusion basically? Conclusion is you rewarded risk only. For example, if entire market has come down, you don't put any effort, just hold your portfolio. When the market will be up, market is going to compensate you for that risk, systematic risk. But for unsystematic risk, market is not going to help. You need to use your brains and move out. Getting it? For unsystematic risk, for fraud in a company, you have to plan and come out. Okay, so smart investors will reduce unsystematic risk via diversification. Okay, spreading holdings across the company, sectors and geographies. You buy the shares of different geography, different sectors, and you diversify your portfolio. Different sectors, pharma sectors, then banking sector, then infra sector, so on, you diversify. So you can diversify specific unsystematic risk, but here you cannot. Only market can reward you, only market can compensate you, right? So here the bottom line is a well diversified portfolio eliminates unsystematic risk entirely. The well diversified portfolio will eliminate the unsystematic risk entirely, leaving only the systematic risk, which is the only risk the market rewards with the return premium. What does it mean? By diversification, you can reduce the unsystematic risk, but you cannot avoid the systematic risk. you cannot avoid the systematic risk. Let us understand this by a diagram. See this. Now this diagram explains you. On the y-axis you have a total risk, and on the x-axis you have number of securities. Suppose you increase the number of securities, what will happen? Your total risk is going to reduce. Why? Because you're getting the benefit of diversification. You are eliminating the unsystematic risk. So your unsystematic risk is reducing. But this cannot comes to zero. This total risk cannot reduce to zero. Why? Because however diversification you do, whatever diversification you do, you cannot avoid systematic risk. Systematic risk only market can compensate you. Remember. So over here, if the unsystematic risk is reducing, it will reduce, it will become zero, unsystematic, but not the systematic risk. So see, this is the total risk. By diversification, what you have done, you have eliminated the unsystematic risk. But what about the systematic risk? This is systematic risk. You cannot avoid, right? So it is very clear, the risk can be reduced, it can be reduced, but you cannot avoid systematic risk. Now, if you do more and more diversification, see, it won't help. Only to a certain extent this can help. Read this sentence. As a portfolio increases, risk reduction slows and eventually stops. Altogether, once 15 to 20 carefully selected investments have been combined. So there can be diversification, but over diversification will not help you. Approximately 15 to 20 securities can help. After that, it won't. Okay, so diversification also has some limit. Over diversification, that will be a very crowded and very congested portfolio. This won't help. Okay, now let's take one exercise. This one. This is 19. The following factors have impacted the volatility. Let me just volatility of the earnings of Chokbik company and manufacturers of chocolate, biscuits and cereals. We have to identify whether the risks are systematic or unsystematic. Okay, number one, increase in the interest rate. Now this is going to affect the entire economy. This is not company specific, it is a general risk. So this has to be systematic risk. Okay, increase in the price of cocoa beans. Now this is going to affect only the chocolate companies, not the entire market. So this can be treated as unsystematic risk. Legislation changes the rules of tax relief for investment in non-current asset. This is going to affect every company. This is not for specific choco companies. Systematic risk. Growth in economy of the company where Chocobik is based. Growth in the economy of the country where this company, the entire economy is increasing, not only that particular company. So entire economy, systematic risk. Government advice on importance of eating breakfast. Now when I say eating breakfast, now this is going to affect only those companies which are involved in product involving breakfast. So this is unsystematic risk. Industrial unrest in Chokbik company main factory. So this particular company's main factory is affected. Only that company will be affected. It will be unsystematic risk. I hope the concept is very clear. This video helped you. Okay, now I'll be coming with the next video on CAPM, Capital Asset Pricing Model. Happy studying, please study, and to get my videos you can visit the website Let's Learn, or you can contact 844-844-8919. Thank you.